In today's video, I am going to be breaking down and comparing CALL, the ETF, as well as ZWK, which is a BMO version of essentially the same ETF. However, there are a few slight differences, so let's get down and let's check these out. So the first ETF that we are going to check out is the Evolve US Banks Enhanced Yield Fund, and of course this goes by CALL. So their target yield that they are trying to get every single year is going to be 7%. It also currently only holds 20 stocks, and of course that would be of the American banks. And the style of ETF is, of course, a covered call strategy based on the index of the US banks. Basically, what a covered call is when you hold stocks and then you would sell call options against those stocks. Of course, when you're selling a call option, it would be for 100 shares. And then when that happens, essentially you are promising to sell those shares at today's price in the future, let's say 6 months down the road, and as long as it reaches a certain price target. So let's say, for example, today the stocks are worth $60 and your target price is $80. You're selling that call option to guarantee today's price in the future to whoever buys that call option. However, they're going to get those shares at $60, but only if those shares reach $80. And then they would pay you a premium, which is why you're getting such a high dividend. And then if that stock never reaches that $80, then what would happen is you would keep that premium money, so that's that dividend, and then you would also keep your shares because it never reached that price target. However, if it reaches that price target, that's when you would lose those shares to that person. So I really do like their website versus others because they actually show a historical price as well as the cumulative return. So the historical price historically has gone down before the COVID crisis. Now, of course, the banks were kind of trading sideways anyway, so that's not exactly enough data, really, in my opinion, to see how well this ETF performs. However, at the same time, we can see that it has recovered back to that point where it was at before, roughly. But again, banks have been declining again. So to me, this is not moving as much as the banks move, which you wouldn't normally see anyways with a covered call ETF. However, at the same time, some ETFs you will see a massive decline over time, but we just don't see a long enough history because it's still a fairly new ETF. However, the cumulative return is, of course, when you start reinvesting those dividends. And when you start reinvesting those dividends, from the day one up until today, if you were investing all your dividends throughout this time, you would be currently at a plus 20% on your initial investment. So if you invested $10,000, then of course now it would be worth around $12,000. Now the top 10 holdings are all really solid companies. Some of my favorites out of these holdings are of the following: Wells Fargo, Ameriprise, both fantastic. Goldman Sachs is another one of my favorites, as well as US Bancorp and Bank of America. JP Morgan is another one of my favorites, and of course Signature Bank New York is as well one of my favorites, all roughly around that 5% range. As we can see, it is a monthly dividend and it pays roughly 11.5 cents every single month. We can also see from our history that, of course, the dividend does go up over time. Now, moving over to ZWK, which is the BMO version of that same ETF, essentially. There are a few differences, though, so we're going to get to that. The management fee of call is 0.45%, while the management fee of ZWK is much higher at 0.71%. Currently, the annual distribution for the yield is 7.3%, so it's roughly pretty close to call. It's about 0.3% off, or about that much higher, but that makes a little bit of sense considering that the MER is a bit higher and you generally should make more money with a higher MER. That's not always the case, but sometimes it is. Now, the yield for this ETF is 18 cents per share, and its current price is around $29.20 per share. Now, the fund benefits for this, as well as call, is of course it's designed for investors that are looking to make a higher income, and that's that premium from those call options. And of course, it's investing in the U.S. banks, and the call option writing does reduce volatility, which means that you're not going to be seeing massive spikes as you may see on the stock market, but that should also protect you against sharp downturns as well, which is of course something that we recently had. Now, the top shares for this ETF is First Republic Bank. This is the major differences that you're going to see. Wells Fargo, Goldman Sachs, some of my favorite US Bancorp, Bank of America, JP Morgan. Some of these are going to be the same, while others are going to be slightly different weightings as well. So something to keep in mind if you really do want to invest in these two ETFs. I'm not going to say which one's really actually better than the other, but what I would suggest is to find the shares that you personally like the most. And of course, let's say for example you had 8 on this list and 5 on call's list that you liked. Well, guess what? I would go with the ETF that has more of the stocks that you personally like yourself. Also, ZWK does cost more money, but it does give you more of a dividend. We can also see that it's also not been around for a heck of a long time. However, it has had, before the COVID pandemic, a higher increase in price before the whole pandemic. It went from roughly 30 to 32, of course, dipped down to about 18, 17 range, and now it's recovered slightly. I really want to see if it can get back past $32. If it can, then this is looking extremely nice. However, one thing I do want to really look at is the fact that these do trade very similar to each other, as we can see the downturn here, and of course the downturn there. These are going to most likely, in most cases, trade very close to one another. So you can't really go bad between these two ETFs. What I would personally look at is look at their top 10 holdings and see which one aligns with your thoughts the most. Then look at the yield and say, okay, well, percentage-wise, one is going to be better than the other. ZWK does seem to be paying more. And then it comes down to the actual MER. Are you willing to pay the extra 0.3% higher yield, which is on about $100? I think that's like 30 cents if I do my math right in my head. So not a ton. It's about $3 for every 1,000, roughly. It's not really all that massive, so keep that in mind. I hope that this video has helped you choose between these two very similar ETFs. If it has, hit that like button, subscribe. I'll see you guys again next time.